Welcome back to our next lecture. Derivatives basically consist of two key products that are futures and options. Both are commonly used trading tool, and trading either of them is little more complicated than simply buying stock. If we use correctly, they both offer plenty of opportunities for making money in stock market. They both are widely used to benefit from leverage. Options and futures are often confused with each other. But they are actually very different from each other. Those who don't fully understand how they differ from each other can make big mistakes in stock trading. So in this lecture we will know about some similarities and difference between the two and learn why options trading is better than future. So let's have a look at the similarities and difference between the two. A future is a right and obligation to buy or sell an underlying asset at a predetermined price and time. And an option is a right without an obligation to buy or sell an underlying asset. Both futures and options are products that derive their values from the value of underlying asset. They both are the financial contracts that exist between two parties, the buyers and the sellers, and both are the leverage derivatives. Now the fundamental difference between the options and the future is in the obligation of the parties involved. As we know, in option trading, the buyer of an option has the right to buy or sell an asset at a fixed price but not the obligation. And an option seller always have an obligation. But in a future contract, both the parties, whether buyer or seller, are obliged to fulfill the terms of contract. This is the main difference between options and future. Therefore, buying a future is more riskiest than buying option because while buying options, we have the risk of premium only. But with futures, if we buy a future and stock price falls, we are obligated to suffer that loss. Now in case of selling, when we sell options, the seller of the option receives the money that the buyer pays, but with futures seller receives no money at the time of initiation of the trade. Both buyer and seller are required to have a certain amount of margin on hand. Unlike an option buyer in futures, a trader has to pay a required margin amount approximately 20% of full value, and he may also be required to top up that margin if the underlying security moves against him. But the option buyer owns the contract outright, so no further fund will be required from him. This is the main reason why future trading is generally riskier than option trading. Now let's discuss the advantages of options over futures. When trading futures, you are potentially exposed to big losses whichever side of contract you are on if the security moves against you. But in buying options you can lose your initial investment. Only when you are an option writer you are exposed to similar risk. Assume that you want to buy a stock ABC that is trading at $30. So if you buy 100 shares of ABC you need to pay $3,000. But if you want to buy one lot of ABC future, you only have to pay the margin, which is around 20% of full value. Depending on your broker, it means your profit will be 5 times that of when you are invested in equities. But unlike the case of options, your loss could also be 5-folds. And that is the biggest disadvantage of trading futures. Now in this case the premium of the call option is only $3, so if stock price falls, the only loss in this case will be $300. The other advantage of options over future is that with options you can adopt a number of strategies and create spreads that can enable you to profit from multi-directional price movement, but with future contracts, you can only make money from the security moving in the right direction for you. So these were some similarities and difference between options and futures. In this course we will learn about options only, and we will learn about different strategies that we can adopt with options trading. See you in the next lecture. Thanks for watching.